Well, our first guest says, while the CEO change at Starbucks is a good first step, challenges for the company remain. Wedbush's equity research managing director, Nick Setyan, joins us to explain why he is not one of the many analysts upgrading the stock today. Nick, great to have you with us. So it's deeper than just who's at the top at this point. It's macro.
Well, Chris, thanks for having me. I think, a lot of challenges are macro, right? I mean, the slowdown started at the end of last year, coinciding with, McDonald's and much of the industry. And before that, they had positive transactions, year after year. So everything was fine until the macro slowdown.
But Chipotle also had to weather the macro slowdown and didn't it weather it better. And so therefore, that begs the question, isn't Nickel the kind of person that you want at the top at this point? And can't he help the company execute even with that backdrop?
There's a couple of Chipotle-specific things going on, right? I mean, they, first of all, they're one of those sort of relative value plays going into this year that we had highlighted. Second, they're still benefiting from a lot of May innovation. And again, that's credit to Brian Nickel. But it's not a tool that you can use at Starbucks because they've been doing it for decades now in terms of, LTOs and seasonal offerings. But the carne asada is what drove that big comp and kind of overcame the macro headwinds. And we've already seen a slowdown and a reset in 2H in terms of the 2H expectations, the second half expectations at Chipotle. So the macro is catching up.
Hey, Nick, if you're a sell-side analyst, which you are, and you upgrade a stock, right after the opening, do you get the previous day's price for all intents and purposes for your just help me out with that for a second.
I've never upgraded a stock intraday. I think you probably would if it's intraday.
Yeah, I guess my only point is, so the analyst community was way offsides this. The sentiment was really bad. Investors, they couldn't sell it low enough. And so it's interesting to me to see this sort of chase today. Do you think they're going to have the ability to grow into this valuation that looked cheap to the market yesterday, but now looks expensive to it?
On the one hand, it's still trading at a discount to its sort of pre-COVID or historic, any way you look at it, still trading at a discount to its historical sort of valuation in terms of where Starbucks is today. The bottom line is there's still, very, very limited visibility in terms of what they do in FY25. Now, you could have had no CEO and you're still going over a down 7% transaction quarter in their fiscal Q2, right? So their March quarter is down 3 comp, down 7 transactions. So you have very easy compares to go over next year. So I think, the setup is you basically have a near term where it's completely de-risked, with Brian Nickel, no one's really going to care what the current quarter looks like. And you have some very easy expectations and hurdles to go over basically for the next, 4 quarters.
But Nick, I thought one of the most fascinating points you made in the notes you sent to us is that you just think Brian Nichols is a marketing guy. I don't think you were necessarily dismissive of his. In fact, I think you were lauding what he did at Taco Bell. Came over into a similar environment with a similar customer base. But that marketing is great, and clearly CMG has been a marketing dynamo over the last few years. But is that a limitation to what he could do at Starbucks when, in fact, it does seem very operational?
I think so. I think, marketing is not Starbucks' problem. Their current, customer base is still coming in more often. They're spending more than they ever have. The problem is that aspirational customer that came in during, the COVID years when stimulus checks were going out, and now they're no longer there, right? Number one. Number two, the day parts have shifted, right? Pre-COVID, you had a bigger morning day part. Now you don't have as big of a morning sort of habitual customer. And then 3, you were more of an urban, sort of concept, right? Now, over the last 5 years, you're building drive-throughs in the Midwest and the Southeast. So it's a different customer you have to address. And so maybe he has an opportunity to figure out a way to address that customer. But Starbucks has shifted, and it's just not the same company it was 5 years ago.
Maybe he can bring carne asada to Starbucks. I'm just joking. But would you expect Starbucks to really increase CapEx going forward? If they're going to lean into sort of technological innovation or improvement in the operations, can we expect to see that? And so therefore that could be a speed bump in terms of how the stock trades.
I actually think CapEx goes down. I think they curtail the unit growth, and that's where most of the CapEx is. So even if they're doing, spend incremental on tech, incrementally on technology, I think they're going to curtail unit growth for the next year or two to try to essentially lower cannibalization and bump up that same-store sales growth.